Imagine losing your hard-earned cash in mere seconds because you overlooked one critical aspect of cryptocurrency trading. This factor determines whether you can sell your assets timely and profitably or end up stuck with them, watching your money split away. Today we're talking about liquidity. Hi there, I'm Eva, and in this video we're diving into the world of liquidity. We'll explore what is it and how understanding it can safeguard and boost your crypto investments. Let's jump in. So what exactly is liquidity and why does it matter so much? Picture this. You're at school with a chocolate bar craving some gum. If the school store has plenty of gum and the seller's eager to swap it for your chocolate right away, that's high liquidity in action. The exchange is quick and hassle-free. Now flip the script. The store is almost out of gum, or maybe the seller is not interested in your chocolate. That's low liquidity. Suddenly making that trade becomes a challenge. You might find yourself waiting around or accepting a deal that's not in your favor. In the crypto universe, liquidity is all about how swiftly and effortlessly you can trade your digital assets at a fair price. Picture a bustling marketplace. That's high liquidity. Here are plenty of buyers and sellers making transactions fast and efficient. On the flip side, low liquidity is like a deserted bazaar. Deals are slow and you might not get the price you want. Take Bitcoin for instance. It's the superstar of crypto. As easy to trade as the dollar, but some unknown tokens, you might struggle to find anyone interested in buying it. Here's the kicker. Highly liquid assets aren't just easier to trade, they're also more stable and less prone to sudden price roller coasters. Why? Because when you have lots of market players, you can see gradual changes in supply and demand, which helps prevent unexpected price jumps. This stability is a lifesaver for traders and investors. No one likes bad surprises. Now, how can you tell if a coin is a liquidity superstar or a wallflower? Let's break it down. To spot high liquidity, keep an eye out for these 3 green flags. First, tight spreads. These refer to the minimal difference between buying and selling prices, preventing traders from losing money on excessive fees. On major exchanges like Binance, the spread for Bitcoin might be just a handful of dollars, a tiny fraction of its total value, which can be in the tens of thousands. It's comparable to selling an apple for $1 and immediately getting an offer for 99 cents with hardly any negotiation. Second, high trading volume across multiple exchanges. The more cryptocurrency exchanges offering the asset and the more people actively trading it, the higher its liquidity. Take Ethereum as an example. Its daily trading volume can reach billions of dollars. This creates a vibrant marketplace where assets change hands rapidly, allowing you to trade confidently without worrying about sudden price fluctuations. Third, price stability. In a liquid market, even large transactions, say selling cryptocurrency worth several $million, don't cause significant price jumps. The market easily absorbs these volumes, maintaining price stability. This smoothing effect of liquidity helps reduce price volatility and makes the market more predictable for traders and investors. Now let's turn our attention to 3 warning signs of low liquidity. These are essentially the opposite of what we just discussed for high liquidity. First, wide spreads. Imagine trying to sell an apple for $1, but the best offer you receive is only 50 cents. This significant gap between buying and selling prices is a clear indicator of low liquidity. Second, low trading volume. This suggests the asset isn't in high demand. When there is little interest in a project, it becomes challenging to buy or sell its cryptocurrency. It's akin to attempting to sell a product that's unknown and unwanted in the market. Third, high volatility. This refers to how rapidly and dramatically an asset's price changes. If you notice frequent sharp increases and decreases in price, that's a sign of high volatility. In markets with low liquidity, even minor trades can trigger significant price swings. For instance, buying or selling a small amount of an obscure token could cause its price to rise or fall dramatically. This occurs because there are not enough active buyers and sellers to stabilize these price movements. Now let's explore two visual methods to assess an asset's liquidity. First, market depth. This shows current buy and sell orders for the asset. You can gauge liquidity by examining the number of orders and how they are distributed. But be cautious, this indicator isn't foolproof. Some market makers might create an illusion of liquidity by placing fake orders they can cancel instantly. To safeguard against this, consider cryptocurrencies traded on multiple exchanges. This approach minimizes the risk of artificially inflated liquidity and enhances trade reliability. Second, look for absence of frequent squeezes on price charts. Squeezes appear as candles with long shadows indicating sharp price spikes often linked to low liquidity. Repeated downward squeezes might suggest large market participants are rushing to exit at any price, a potential red flag for the coin's future. Now that we've covered how to determine cryptocurrency liquidity, let's consider 5 crucial factors for those planning significant investments. 1. Order execution time. Even with high trading volume, delayed order execution can occur. This often points to a shortage of market participants, potentially signaling decreasing liquidity. 2. Influence of large players. Major investors, often called whales, can substantially impact liquidity and prices. Monitor their actions to anticipate potential market shifts. 3. Tokenomics. Cryptocurrencies with well-planned token supplies tend to be more stable. Oversupply can diminish liquidity and potentially lead to inflation, reducing the token's value. 4. Institutional investors. Interest from major companies or funds is typically a positive indicator for a cryptocurrency's liquidity and stability. 5. Correlation with other assets. Some cryptocurrencies' liquidity may be influenced by major market players like Bitcoin or Ethereum. Their movements could affect your chosen asset. The key lesson here is that understanding and leveraging liquidity can enhance your trading and investment strategies. What about you? Do you lean towards trading highly liquid coins, or do you prefer the potential rewards of lesser known tokens? Share your experience in the comments. Subscribe, like this video and activate notifications to stay updated on our future content. This was Eva, see you next time!